Okay, Jaden, thanks for joining us this month for the Fireside Chat.
And good to be here. Thanks, Rob.
Mate, we've just been through reporting season. Just generally, what's been your take on reporting season and what companies are reporting?
So reporting season performance-wise was good. Index was up 3% for the period, but overwhelmingly the biggest driver of that for the period was valuations rather than earnings. So earnings growth continues to be, depressed is not the right word, but challenged. So in terms of beats and misses, it was very similar to February where about 30% of companies beat by 5% or more and 20% of companies missed. But where a company missed again, those companies got smashed. So the companies that beat or met expectations did really well. The market bid those names up as they continue to shift. Markets continue to shift to more defensive names. So where there's more certainty about the earnings outlook, those stocks were bid up. But where a stock missed, they got torched. So there's a few good examples of that for the period. CSL is the most notable one, which is in the portfolio, so we can touch on that later. But broadly good results, but doesn't get us super excited about the forward outlook either. So valuations continue to look elevated. Earnings growth will have to drive the market from here. There's only so much more multiple expansion we can get, and that earnings growth doesn't look all that attractive on a forward basis across most sectors. Some look worse than others, but in most places, the markets or the index doesn't look overwhelmingly exciting.
So what are the sectors that I guess the valuations aren't looking as stretched?
Health and some components of resources. So they're the two big ones. So healthcare was the only sector that posted a negative return throughout August. So healthcare sector was down 12% for the period. Materials was the strongest, but still valuations there look quite cheap. So there's a few names in that sector, especially the big ones, BHP Rios valuations are below their long-term historical average. And there's good reasons for that, but nonetheless, those sectors do look slightly more attractive on a valuation basis alone versus some others.
Yeah. Okay. Cool. Well, I mean, ultimately, we've spoke in the past previously about valuation is a massive contributor to future returns, right? If you're buying assets at high valuations, you need a lot of things to go in your favor to be able to make returns. So
yeah, absolutely. The other sector I'll call out is just consumer discretionary. So consumer discretionary posted the biggest valuation expansion for the period. So 4 PE points higher through the month, which is massive. So that's market coming to almost a conclusion that the consumer looks healthy again, people are spending again, and we're seeing that a little bit in the CBA data. So younger people had positive spending growth for the first time in a while, but the cost of living challenges aren't going away anytime soon, and we're not going to get back to spending levels that were the case pre-COVID for some time yet, especially in those younger cohorts. They're still not spending as much as they were.
Yeah. Okay, so you mentioned the portfolio, so the direct equities portfolio that we have. What was the highlights or the lowlights in the stocks that we hold, and what are your thoughts around that?
Yeah, I'll start with CSL as the disappointment. So probably the biggest and most topical result throughout all the reporting season. Stock was down 20% on the day. That was all valuation move. So that 20% down wasn't based on earnings. They actually largely at a total group level met expectations. Behring missed a little bit on revenue and margins, while Securitas beat. So the vaccine business beat expectations. Now, the market was far more focused on some of the structural changes coming through at CSL. So divesting the vaccine business and making some big adjustments to the R&D component of their business. There's a few tricky things with CSL. They want to maintain their margins. It's a stated focus, especially on the plasma collection part of their business. But that space is far more competitive than it used to be. So they can either chase volumes or margins to grow that business. Their view is they want to keep margins high, but that means they're not getting the volumes because there's other people willing to come in at lower margins. So that's a challenge where maybe it doesn't have the same growth rate it did previously going forward, which is why the valuation came off. Now, I think over the next 12 months, CSL is likely to trade sideways with more risk to the upside and the downside. I think there's a lot of negativity priced in, but there's no real catalysts for that stock to go up yet. We still don't know what the vaccine business divestment is going to look like. We don't know how much R&D expense they can realistically take out without torching the most important growth engine, long-term growth engine of that business. So there's a lot more question marks, which is why the valuation moved where it did. So at the moment, our view is to hold, given how aggressive the selling pressure's been. So they've been buying about $20 million worth of stock on market every day since the result. So and the stock isn't moving. So if that's how big the buyback is, you can imagine how much selling pressure is on the other side. And yeah, and a lot of the fund managers we look through, they're sitting underweight now. So we think a lot of the selling is largely not complete, but can be offset by the buyback. There's still hundreds of millions they've got left to go. And that's a sign of confidence. So that sees us holding for now rather than selling. But CSL was the big disappointment for the period. The positive one I'll call out was Worley. So engineering contractor, a lot did well through the period. So Downer, Ventia, they posted good results. There's good rationalization coming through that sector where they're pricing contracts much more effectively and much more sophisticated than they were previously. So market really liked the guidance on the day of the result. And the other big one was a statement on the earnings call that nearly 50% of Worley's work is uncontested. They're competing with nobody. There's a lot of the ESG sustainability related engineering work that there's just no one out there that can do this sort of work. There's not people that that the miners can even hire to be able to do it because there's massive shortages of these sorts of skills. So Worley is going to see more higher margin contracts come through. That growth isn't going away anytime soon. So that was a really positive result for the period.
Yeah, it's good to have a business where you got no one competing against you. That's a nice place to be.
Sure is a very nice place to be.
So from the equity market side of things, we've spoken about valuations, which obviously then leads into when we sort of talk more about portfolio management from a client perspective. Obviously, we talk about strategic asset allocation, and obviously equities is only one component of that. We've got fixed interest, we've got property, we've got infrastructure, we've got our precious metals, we've got alternatives, we've got a whole range of different asset classes, which the portfolio approach is all about, well, we don't know what path things are going to take. So the idea is we obviously need to have assets that are going to be behaving differently at the same time. In regards to, I guess, how we're positioned overall within the portfolios, we're taking a very, I guess, I would consider it relative to the market, a very defensive approach. If we look at a lot of the industry funds in a balanced portfolio have a large exposure to, say, growth assets, well above 50%, sometimes encroaching 80 and beyond. So from that perspective, not only, is our strategic asset allocation a little bit more conservative, for the lack of a better word, but we might even just talk about, I guess, how we're undertaking the equities sleeve within that portfolio, and how we've got it positioned, given that you've sort of just touched on, there is aspects of the market that, are fairly expensive from historical perspective, and then there's parts of the market that isn't. And we've also, within that strategy, we've got exposure to strategies which aren't reliant on just the market. So we've got, alternative strategies in there from an equity side of things to ensure that, we're able to get a return that's different to just the market beta, if you will. So have you got any sort of comments overall just about how we're positioned and any thoughts on that?
Yeah, so broadly, portfolio is still positioned defensively. So underweight growth assets slightly at an overall level, especially versus some of the industry funds. So big reasons for that are valuations, one, but we think the earnings outlook looks increasingly challenged as well. With valuations at all-time highs for the US and Australia, earnings growth will have to drive the outlook again. And outside of the Magnificent Seven, the earnings growth for the US, especially 70% of the MSCI World Index, doesn't look that attractive. So over the last 6 years, the fundamental quality of the S&P 500 hasn't actually improved at all. So all of the return has come from valuation and currency. So currency in the US looks very expensive, and we don't think that goes high from here. It can trade flat, but it's not a contributor to relative outperformance. And then valuation again looks very high. So that's not going to expand much further, if at all, given where it's trading. So earnings growth and fundamental improvement of businesses has to drive it. And that hasn't happened in 7 years. And that's even with the Magnificent Seven and the Nvidias and the Metas posting huge gross profit growth throughout that period. The rest of the index has been so poor that at an aggregate level, the index hasn't actually improved in quality at all. So we're worried about what that means for US outperformance, or what that means for the world global indexes, which is why we're positioned defensively. Now, at the same time, we can go into other asset classes like fixed interest or like alternatives and get less correlated return streams that are actually attractive today versus where they were previously. So we can get 6-7% on AA or even BBB credit, which is very attractive versus the risk I've got to take in equities to maybe get 1 or 2 percentage points higher, especially when I don't have as much confidence in that 1 or 2 extra percentage points. But that's why we're positioned the way we are.
Yep, no, absolutely. That was well put, mate. Good summation. All right. Well, just in closing, have you got any further thoughts that people should be tucking away? Obviously, there's a bit of a buzz around the precious metals. They look like they're starting to move. They're probably a little overcooked in the short term, but any thoughts in that space at the moment?
Less precious metal thoughts from us. More rare earths is one we've been watching closely. So you've seen the share price performance of Linus, especially over the last 12 months, has been phenomenal. I think it's up 150, 60% year to date or last 12 months. So very strong numbers through that period. A lot of that has been companies and governments in the West ensuring their own supply outside of China. So we're getting this bifurcated price where contracts in the US are being done at 2-3 times what the market price is for some of these metals and some of these rare earths. So that will be interesting to watch over the next few months to see if some other Australian miners especially can take advantage of that bifurcated price. If that doesn't come through and if we don't get the same contracts, there will be significant share price correction in some parts of those markets. We continue to like the outlook for gold miners as well. So the gold price is very well year to date, but still not price stays high from here. We don't see any catalyst for it going down in the short term. So I think gold miners continue to look attractive.
Beautiful. All right, Jaden. Well, mate, thank you very much for making the time, and thanks for joining us for this month's Fireside Chat.